I had to chuckle. Just one of our guests earlier saying that this kind of situation and the risks have more red flags than her ex-boyfriends. Are we perhaps being a little bit too sanguine about these red flags?
Maybe, but the evidence so far continues to suggest that despite the high transmissibility, it's not as virulent as the Delta strain was or is. And so we do think it will create some slowdowns in the economy and perhaps some slowdowns in production, which could add to inflation pressures in the short term. But we're looking for those to fade with this next wave of Omicron. So our views are still that the economy works its way through this.
What are your clients asking you about as we look to 2022? Is the key concern still inflation / a Fed misstep?
Yeah, those are the two. So COVID is one, and the Fed would be the other main uncertainty. But the economy, we already knew, was going into a transition period. And so that's the main question from investors as we work through this transition period of less policy stimulus, less policy accommodation, and probably a shift from spending on goods to spending on services. Can the economy continue to generate earnings that will favor stocks? We think the answer is yes, but that you won't see quite the gains that we've seen this year, 25% plus for the S&P 500, a little more moderate next year.
Paul, how do we read the economic data? How useful is it given that things are changing day by day, it would seem now, with the economy?
Yeah, that's a good question. I mean, there's quite a lot of volatility in the markets and in the economic data. So you pointed out earlier that there's some differences between confidence on the one hand and spending on the other. And that's reflecting the fear that people have about Omicron. But look, what's going to drive this going forward is really the savings that have built up over the last several years, even pre-pandemic savings and savings at the corporate level as well. We see those savings being spent. And if it doesn't happen all at once, let's say if we didn't have Omicron at all, we would see much stronger growth now and then a faster tailing off of growth later. But since we do have COVID and uncertainties, we think that that spending will be spread out over a longer period of time and be able to sustain a growth rate that is above the average post-war 3.2%, but that is maybe somewhat slower than last year. Again, that's part of the transition.
Well, it's quite concerning, isn't it, Paul? Because we did see the savings rate decline as well in today's data, 6.9%. That's the lowest now since December of 2017. And inflation continues to eke out more and more of people's personal savings at the moment, it would seem. How much does some kind of Build Back Better plan figure into your forecasts?
Not much. We do think it'll be build back, but probably build back later. And it will be, if not for the same amount, perhaps a little bit less. And it will be in a more limited number of programs. So there will be some stimulus next year from the federal government here in the U.S. But keep in mind, it's going to be difficult to replace that COVID spending that the government did. The last big checks went out in March of last year. So there was already a big fiscal drag in place. That's why we say, again, there's some transition coming, folks, for next year. And our strategy is trying to take account of that. And the savings rate, yes, it's declining on a month-to-month basis, but the accumulated level of savings is still very high. And we think that's what drives the consumer in 2022. So put aside for a moment the fiscal spending, that's still going to be a net drag, but it's the private spending where we want to keep our focus, and that's what we think will drive earnings.
Tell us about some of this kind of sectoral strategies you have going into next year. Will it be another big leadership year when it comes to growth and tech?
We do think so. The markets have been a little skittish in the last few weeks over the prospect that the Federal Reserve will begin raising interest rates. Tech is very sensitive to interest rates, but our view is one, maybe two rate hikes. We think the market consensus at 3 or 4 is too high. It's too pessimistic, and therefore too pessimistic for tech. So we continue to like that sector. It's a good buying opportunity now. We also like communication services. And for balance, we do like some cyclical sectors, which, by the way, should help protect portfolios to some degree in the event of further inflation. So cyclical sectors going up at the same time as inflation, sectors like financials and industrial. So think of that as a barbell approach to a U.S. large cap structure. And we do prefer large caps, by the way, and mid caps over small caps.